Good morning and welcome to everyone who's joined us today. It's really great to have you here at what is the first of a brand new series for EVPA, the Investing for Development series. My name's Peter Kafke and I'm really quite fortunate on behalf of my colleagues Anya and Roberta from EVPA who are on this call and the whole team at EVPA to welcome you really to this first session. You've picked a good one. It's a great panel. There's some real insights to be gained from here. You'll be also happy to know I'm not going to be talking for very long in this. If any of you have joined any webinars I've been involved with before, that will come as a relief. Basically, my job here is just to introduce a few of the housekeeping, a little bit of the agenda, and before handing over to Roberta for some welcoming comments as our CEO here at EVPA. So very quickly, just to put the agenda in context, we are in your calendars for 75 minutes, but we do realize that you are all quite busy people and sometimes people need to leave. So the way we've structured this is very much content rich in the starting 60 minutes. And after 55 minutes, we'll have what's known as a closing light, where I might just return, give you some information about follow-up events. Thank you for your time. But then we'll go into a more informal discussion with all the panelists. And I'd really stress it, if you can, you should really try and stay for that. As we know, while all the panelists will present beautifully, some of the real nuggets come out in those informal discussions for the 15 minutes afterwards. But we are aware as well of Zoom fatigue and things like that. So that's the general vibe of the idea. As mentioned, Roberta will follow me with some comments before my colleague Anya will take us through some of the concepts of innovative finance and introduce the rest of the panel for a discussion session. I suppose, starting from a standing start, the Investing for Development series, EVPA, why are we doing it and what do we think's in it for everyone? I mean, we very much see this as a space where Investors for Impact can make a real difference in helping people around the world. So the very simple concept for the series is to just bring some visibility on some of the major topics in the area, provide a community to start discussions and to see where learnings can be shared, and hopefully really move forwards. And I know everyone's saying it, but accelerate the SDGs in a decade of action always sounds like a very big target, but someone's got to try and do it. And that's the kind of driving force behind this series. On a practical level, we'll be looking to get involved with a number of topics over the coming 12-18 months. We're starting with innovative finance. We'll be looking at social entrepreneurship in Q3 of this year, and also looking at topics like collaboration for change as well later in the year or early in 2022. The reason we start with innovative finance is in one way because it's quite a nice fit with the Investors for Impact community. EVPA members have been engaged in different financial instruments since the creation of EVPA. And here we're talking about innovative finance for development. We'll come on to the concepts, but the way I kind of think of it is a mixture of both tools to bring more capital into this sector and then also to help use that capital more effectively and efficiently once it's in the sector. So that's what we're looking at today. The other thing that I've just got to bring up since I'm in the hot seat is around housekeeping. You will have noticed this is a Zoom webinar. We would have normally done this as a Zoom meeting, but it's just too popular, which is a lovely thing to be able to say, but it does mean we can't actually see you, which I always find slightly freaky because I'm now just staring at my own face. But we would encourage you to use the Zoom chat function below and also the Q&A function. Share a little bit about who you are, where you're from. We may not get to all your questions, or if you raise your hands, we may come to you after the closing light. But we will try and follow up with any questions if we can and make connections where appropriate. So please do use that. It's your kind of space. And then very briefly, because we're already obviously behind time, as all good webinars are, what we thought we'd do, since we can't see you, is do a very quick 20-second poll where we'll just to get a kind of feel for who's actually in the room at the moment. And I realize the danger of this is that you launch it whilst people are still joining or while people are actually still doing other work and not really paying attention to the webinar, so no one clicks the buttons. But we'll leave that going for another 5 seconds any longer, and I might even start singing. And so it's just to give a snapshot there. I can't stop it, it's going up. We'll make it 30 seconds. And that's unsurprising, but it gives an idea, and as more people join us, of the real mix. And I think that's the strength of these events, is bringing together not just one sector, but all of the sectors together to learn from each other and collaborate more effectively. So we will share the results in the Zoom chat, and like I say, please do use that. But in the meantime, I think at that point, I'm just going to hand over to my colleague Roberta for some introductory comments.
Thank you, Peter. Thanks a lot. And it's my pleasure to welcome you today at this webinar and this first series of Investing for Financing, Innovative Financing for Development. As Peter said, this is the first of a series that is focused on an area that's relatively new for the EVPA community, but where we feel that the Investor for Impact can play a really critical role. As you know, EVPA is a very broad and diverse community of investors and organizations like intermediary, market builder, think tank. We're all coming together with the focus on impact and living by the principle of investing for impact. So the long-term engagement, the tailored finance, the relentless focus on measuring and managing impact. And we believe that these principles and these characteristics can play a key role in the sustainable development and in financing for development area. I think you will learn more today from the expert practitioner on the panel about how our impact strategy and high tolerance for risk can play a key role, a key catalyst role in this space, and now the kind of experience that we have in bridging cross-sectors collaboration and financial instruments can again be instrumental with the blended finance approach. I hope that events like this connect and continue the role of connector and bridge cross-sector that the EVPA has been playing for many years, and that you will learn more from the experience in this space, and that this is just a trigger for more collaboration and more partnership. We invite you to continue the dialogue after the webinar and to reach out to the speakers or to Peter and to Anya for any follow-up and question, and to access also the big amount of resources that we have available. And I think there is also a very nice new report that's come out recently from KfW. So without further ado, because I'm also quite excited to hear my peer panelists, I introduce you to the first speaker of today, Anya.
Thank you very much, Roberta. And while I'm trying to bring up this slide here on the screen, just a brief introduction. My name is Anja König. I lead EVPA DACH region and our Investing for Development activities together with my colleague Peter and Martijn Blom. In my non-EVPA life, in the past, I had the privilege to work quite extensively on development finance, and also last year to lead a comprehensive stock-taking advisory assignment on innovative development finance on behalf of KfW and the German government. And so we thought it may be useful for me to provide a short overview on innovative finance before we hear from our panelists. So you may know that innovative finance shows up in many different ways, and there are various explanations for what it is and how it plays out. Therefore, I would just like to mention a few common features. In the past, as Peter said earlier, innovative finance has been mostly associated with the mobilization of additional capital. Initially, it was public capital, and then later on private capital. More recently, the focus has also been on how this capital is then being deployed. So innovative finance can be innovative in many ways. First, by combining existing financing instruments and approaches in new ways and using them for different purposes. So for example, using grants in outcome-based financing structures. Secondly, they can be innovative by applying them to new sectors or markets, for example, introducing green bonds to Latin American countries. Or they can be innovative by involving new providers, new sources of capital. So these in recent times have included philanthropy as, for example, the provider of Catalytic Capital, or the intentional targeting of corporates or commercially oriented institutional investors to bring them into investing for the SDGs. So we can see that there is actually a couple of waves since the notion of innovative finance has first come up, and it's really not a new concept despite the name. It emerged 20 years ago and started with levies, taxes, public-private partnerships, you may remember this still, and as well as political risk insurances. And I feel we're now transitioning towards the wave 4.0. So in this wave, in this new wave, we will see more focus on the democratization of SDG investment opportunities for everybody. So for you to buy your, to invest in your own SDG investment opportunities at your bank, for example, or investing in crowdfunding opportunities, crowd investing opportunities. But also, we noticed in our work for KfW, we noticed really a strong focus now on strengthening local financial markets and mobilizing local private and sometimes also public investors for impact. So that will play a major role. We also felt that a range of innovative financing mechanisms will gain more prominence. That includes, for example, the concept of impact-linked finance or sustainability-linked finance, local currency guarantee, and insurance-based innovative financing mechanisms. Today, we would like to look specifically at outcome-based financing mechanisms and structured funds. But just to say, and you won't be surprised, that there is a huge variety of innovative financing mechanisms. We listed around 60 in our work for KfW, and then classified them in 12 so-called InnoFin families. What is maybe, and there are even some variation on each of them, so it is really difficult to count them. But interesting to me in this work for KfW, where the emergence of endowments and trust funds, where the returns are then used to finance activities that would otherwise not be financially viable. For example, in the environmental sector, biodiversity, there's quite a lot of things happening. Interesting also the emergence of insurance and climate and catastrophe risk insurance, and actually pandemic risk insurance are also an innovative financing instrument that has been applied by the World Bank. But also what I really noticed also was the combination of different instruments. So for example, combination of green bonds with result-based finance to raise commercial funding for agroforestry ecosystem services, for example. So just to give you some examples on how about the huge variety of different innovative financing mechanisms. I'd just briefly like to talk about three concepts that I think are fundamental in the area and the discussion around innovative finance. First is the notion of catalytic capital, where the provider of catalytic capital intentionally accepts lower returns, more flexible terms, longer time frames, or higher risks than conventional investors. And this is not this is in order really to fill capital gaps, but also to fill capital gaps in order to unlock additional investment from more conventional investors. And what is interesting is that the providers of catalytic capital used to be mostly donors and public sector agencies, but now you see much more coming from philanthropic impact funders, as well as impact funds that are between the philanthropic for impact and the commercial side. Secondly, the concept of blended finance you come across quite often. It is the strategic use of catalytic capital for the mobilization of additional capital towards sustainable development. And there are different views on where the focus is. For example, in relation to applying blended finance only for emerging countries, I think there's now the term is being used in the European context as well around mobilizing capital, private capital for impact. So you can really see that also these notions and concepts are rapidly developing. And last but not least, it is the concept of additionality. You may know in the impact investing community, the additionality is sometimes referred to as the impact of the impact investors. So it's the contribution of the impact investor to achieve real world changes on the ground compared to an impact neutral investor, for example. In development finance, it's driven by the concern of public donors and DFIs that if they intervene in the markets and collaborate with private actors, they should avoid using scarce resources on something that the private sector would do anyways, or also avoid crowding out the private sector by offering concessionary terms and conditions to customers and clients. So in search of the unique contribution of providers of impact capital that would justify the use of scarce impact capital, the development finance community identified two kinds of additionality. So there's first the financial additionality that occurs if an intervention mobilizes capital and leads to an investment that would not have happened otherwise. In this context, you often hear about the leverage effect. And there is developmental additionality, which occurs if an intervention generates impact that otherwise would have not occurred without the intervention, or to a less extent, less quickly, less inclusive, etc. So the providers of impact capital, such as KfW, other providers of impact capital, achieve this additionality in many ways. It's not only by providing concessional terms, but also by aggregating and pooling and initiating investment opportunities across countries, generating demonstration effects, de-risking innovative business models, and financing instruments and investments in new geographies, for example, in low-income countries, where otherwise the market would not necessarily go, but also by strengthening the ecosystem in the local capital markets. And just to finish with this discussion, and before we move into more practical examples, just a quick overview on the innovative finance impact value chain to show how the capital, the additional capital, is then transformed into impact. Just to know that you have several mobilization effects, so that if your innovative financing mechanism is designed well, and you invested in local ecosystem building, de-risking of innovation and other systemic and indirect impact activities, you can then mobilize also, for example, a local private investor, and you will have follow-up impact effects beyond your own individual transaction. Just to leave you with a few foods for thoughts, if you like, you can think about your own unique contribution, how your investment mobilizes others and contributes to making an impact on a project, or making the impact of a project or company or vehicle bigger, quicker, more inclusive, etc. The other suggestion would be, or the invitation would be, to look at the specific challenges that you would like to address, and to see really how an innovative financing mechanism needs to be designed to achieve that unique contribution that only you can make as an investor. For example, if you want to get investment into the sanitation sector, how would then the vehicle need to be designed, rather than taking an off-the-shelf innovative financing concept? And last but not least, I think it's really important to note that innovative finance requires a very high level of innovation capacity and willingness for partnership to truly understand the needs of other sectors, such as, for example, institutional investors, but also local governments, for example. So this is certainly something that is also very important in the discussion about innovative finance. It's the innovation is not only out there, it is really with us. So I'd leave it there for now to give us the possibility to dive a little bit deeper into the into the realities. Some of our members have engaged actually in innovative finance in a very practical and effective way. I would first like to welcome Jan Martin Witte, who is the Director of Global Equities and Funds at KfW, Germany's development bank, to share with us how innovative finance plays out at KfW and in his area of responsibility. Over to you, Jan.
All right. Thank you, Anja, for the kind introduction, and also thank you to EVPA for inviting me. I hope that everybody can hear me well. I think Anja has already introduced myself. Jan Martin Witte, I'm the Director of the Global Equity and Funds Department at KfW Development Bank. I do not think I have to say very much about KfW. I believe many of you will know the banking group in Germany is state-owned, the main promotional bank of the federal German government. The development bank is a business area of KfW Group and predominantly is focused on providing sovereign funding to countries, emerging and developing countries, basically on mandates that are being provided by the German Ministry for Economic Development, Economic Cooperation and Development. So as you hear from that, our main mandate and our bread and butter business really is to provide funding to our partner countries, our sovereign clients in emerging and developing countries. And so you may ask, why the heck are we thinking about innovative financing? Why do we think about leveraging private capital? Why do we want to work with you, foundations, but also asset managers and various others, private investors? And I think the simple reason is the very fact that you all know that in order to achieve the Sustainable Development Goals, we will need more than just government funding and DFI funding. I think there are a lot of numbers flying around. I think the United Nations estimates that in order to implement the SDGs, we need around $2.5 trillion annually. That is a tall order, obviously. And in order to accomplish that, we obviously need all the funding we can get. And I would also go just beyond funding and say it is not just the capital that we need, but I think in order to help transform the countries that we work in Africa, Asia, Latin America, we also need private expertise and experience and the commercial drive and entrepreneurial spirit of all of you in order to make change happen. I think Anja has already spoken a little bit about the innovative financing space that KfW is involved in. Really, this is not new. I think for the last 20, 25 years, we've been trying to find ways in which we can branch out of our traditional business model in providing either grants or loans to our sovereign clients to see whether we can, through results-based financing mechanisms, outcome-based finance, how we can get commercial funding in, how we can get this commercial private sector expertise into the development projects that we support. I think it's a very impressive screen that you showed, Anja, with the 60 different mechanisms, very confusing when you look at it. And to a certain extent, I think that also for a long time sort of represented the reality on the ground. I think there's a lot of experimentation going on, also a lot of failure, but failure is always something that you can learn from. The specific business that I am responsible for at the development bank is our equity business, which is also about 20 years old, really had its nucleus in the microfinance movement in the late 1990s and early 2000s, where we as a bank helped to nurture and develop more than 50 microfinance institutions, predominantly in Asia, Latin America, but then later also in sub-Saharan Africa, and that we anchored with direct equity contributions. In due course, we followed up with the creation of a variety of funds, many of which are actually being managed by Finance in Motion, which Milena today represents, which are providing either liquidity or capital to these microfinance institutions. So that was really the core of what we have traditionally done. We now have about 60 of these funds and about 30 direct equity investments still in our portfolio, with a total asset base of around 3 billion euro. But since the early 2000s, we have branched out significantly from the microfinance area to also include investments in a variety of other sectors, including agriculture, biodiversity protection, renewable energy, capital market development, climate insurance. I think the very fact that this portfolio has grown so much really underscores the fact that in our view, these new innovative financing tools that are designed to also bring the private sector along have really a key role to play in financing the implementation of the SDGs going forward. And really, as you all know, this whole impact investment industry has turned a little bit into a growth industry in recent years. And perhaps, Peter, you can move on to the next slide. And by some measures, it's impressive. I think the IFC now estimates that there's about $700 billion that are sort of invested in impact investment funds. But in our view, there are at least three challenges with that sort of emerging market. The first is, if you compare the investment stock that we currently have, the 700 billion, to what is required, the 2.5 trillion annually, it is clear that it is still way too little, even though the growth rates are quite significant. I think from our perspective as a development bank that has a core mandate around supporting the least developed countries, what is also notable is that much of the impact investment is still concentrated in the OECD world or in better rated developing and emerging countries. And we really want to see more of that funding go into the LDCs. And then thirdly, at least from our perspective, not all that glitters is really gold in that market. So there's no real clear and accepted standard for how these impact investments are supposed to be structured. How impact is supposed to be incorporated into the design, how it's supposed to be measured and followed up on. I think the IFC operating standards for impact management are one important start into that regard, but clearly from our perspective, a lot more needs to be done to establish common standards and to really show that these impact investment funds make a measurable and long-lasting sustainable impact in the markets that they are active in. And that's really where we as KfW are playing a role and where we hope to do more in the future. I think we are doing this predominantly through three different ways. And I will give you a couple of nuggets at the end, new fund opportunities that we are hoping to close this year, where we are still trying to find investors, and perhaps some of you might be interested. So please feel free and reach out to me. But in general, we do that. We engage in these funds. We're trying to bring others along by providing first loss tranches. I think Anja has already referred to that as Catalytic Capital. So we are one of the investors who's willing to provide an asset class into these funds that is sort of more risk-taking, that accepts a lower return, on the back of which we hope we can bring private investors along. We also bring in grant funding to provide funding for technical assistance facilities that we believe are crucial in order to make these impact investment funds work. And I think as KfW, with our 70 offices around the world and our partner relationships in the countries that we work in, we can also offer a very strong network for these impact investment funds and their investors in order to move our agenda forward. Perhaps just two examples of funds that we are hoping to close. Peter, if you move on to the first one, that's the European Africa Fund. That's a venture capital fund that we hope to close in the third quarter of this year with an initial seed investment from KfW in the amount of 50 million euro. That really is a fund that is designed to promote SME development, to support the African startup ecosystem. What is perhaps notable here is that we are hoping not just to fund companies from the African continent, but also European companies that are hoping to branch out into African markets. We're doing this together with Partech, who many of you will know is an experienced VC investor on the African continent. And we're still hoping to raise additional commercial and philanthropic investments into that fund. So if that's something of interest to you, please feel free and reach out. The next one is the Verdant Capital Hybrid Fund. That's really a fund that will be able to provide tier 2 capital to microfinance institutions. That's a relevant intervention in the context of the unfolding COVID pandemic and the economic implications that this will have on many of our banking partners in African markets, where we see that we're not looking at a liquidity crisis, but really very much at a capital crisis because of the eroding quality of the credit portfolios that these banks have on their books. That's a fund that we will capitalize with an initial investment of 30 million euro. Will also be incorporated in Germany, and where we're also hoping to raise additional funding from philanthropic investors, impact investors, and obviously also commercial investors. We hope to close this late in Q3 2021. Now, just by way of closing, the funds business and the sort of first loss and TA investments that we make is just one sort of part of the innovative financing toolbox that we're employing. As Anja has pointed out, there's a lot more, predominantly in key areas where we have a strong mandate, specifically around the green or the climate agenda, be it around green bonds or renewable energy. So I'm happy to also engage with any of you who have more questions about what we do other than just structured funds and equity investments in our world, and to see whether we can find sort of areas of mutual interest. I just want to close this really with a plea, and I think we'll get to that later as well. I think for us, when we look at the history of our sort of innovative financing toolbox, including the funds, if you look back at what we have done in the past, I think there's a lot of gold in a way in terms of impact, and I think many of the funds that FIM, for example, manage, has a very high quality asset base when it comes to impact orientation and so forth. But I think what we have not been very good at is really trying to get commercial and philanthropic investors to the table. A lot of the programs and funds that we have sort of structured in the past very heavily rely on us and our fellow DFI partners for capitalization. And this is something that we hope to change and where we hope to engage with you going forward. Thank you.
Thank you so much, Jan. That was really a nice insight into your work and the world of development financing institutions. We'll stay on the topic of funds that Jan introduced. And I'd like to welcome Milena Bertram, who is the Director of External Relations and Impact and Sustainability at Finance in Motion. And Finance in Motion really is a global impact asset manager specialized in advising innovative blended finance funds and managing these funds with around 2.5 billion in assets under management, and really a pioneer, I would say, in the domain of structured funds. Welcome, Milena.
Thank you, Anja, and thank you for the kind introduction. Then I don't have to say much on the first slide, which always stick to that one. I don't have to say much on Finance in Motion, which Anja rightly said, we're experienced in managing these public-private partnership funds, which are now referred to more frequently as blended finance funds. And I brought this slide to visualize a little bit how they're usually set up. The first of these funds was set up actually in 2005. And since then, this concept has really been replicated a whole lot and also fine-tuned in the meantime. And I'll say a few words on that later on. But why is this so innovative and important for the development finance world? Well, because it mobilizes more development finance than either sector, the public or the private, could achieve on its own. And how this works is that there are junior shares that are provided by the public side. That could be the EU, governments across Europe. KfW facilitates a lot of that. And because they provide this first loss piece or the risk cushion, private sector investors are incentivized to invest in regions or topics that they might have shied away from without this risk cushion. So that way, the catalytic capital is really used to create more impact and to mobilize funding and thus simply have more money available for the purposes of a wide range of topics that could be in microfinance, SME finance, health, but also a lot now, of course, on green topics ranging from climate finance, but also biodiversity, etc. How much of this is usually now in junior shares, the mezzanine piece and notes? That differs, of course, from fund to fund a whole lot. Approximately, I would say there's a third in the junior shares, a third in the mezzanine pieces, and then a third in the notes. But it really depends, on the topic. So we clearly see that currently the green topics are of huge interest to the private sector investors. And in these funds, we see more private capital flowing in, and therefore also we can decrease the public risk cushion. Then other topics or newer funds as they scale, of course, need still a much stronger risk buffer. Peter, can you move to the next slide? Thank you. What has happened then, so these funds were set up simply with junior shares, a mezzanine piece, and then notes signed by the private investors. Then after a while, we realized that local currency is really strongly needed, particularly for microfinance and small business finance. And therefore, that's also the beauty of these funds, that you can adapt them. They're usually, it's never a very easy task, but they are quite flexible and also changing capital structures. So a whole new share class could be introduced as the need for local currency investing increased. So instead of public money being used as a general risk cushion, the German government and the European Commission, but later on even the Central Bank of Armenia, provided funding for this so-called L share class, what we called it, which stands for local currency. So they provided funding and set it aside to absorb potential downside risk of currency fluctuations. So that way, local currency loans can be extended to the investees in our target regions without exposing the senior shareholders and note holders to currency risk. And that way, the fund remains attractive to private investors from a risk-return perspective, while strengthening its responsible finance profile and creating more impact on the ground. What are other, and then we can move to the next slide, what are other maybe aspects in terms of innovation within structured funds? As I said, they're not necessarily static, but can be adjusted over time, including the shareholder structure. But they can also cater to a range of asset classes and geographic foci. If set up as an umbrella structure, new sub-funds can be added, for instance, which is sometimes easier than enlarging the focus of an existing fund, where you always have to make sure that the existing investor base is happy and agreeing to a whole new set of risk-taking, potentially. So the Sanat fund that we're advising has a debt sub-fund, but also 2 equity sub-funds, and additional equity sub-funds can be added over time. We've also seen a geographic expansion to new regions. The Eco-Business Fund, for instance, started with a sub-fund on Latin America and the Caribbean, seeing the success of that fund and the topic being equally important to Sub-Saharan Africa. Lessons learned from that particular fund were then used to set up a new sub-fund focused entirely on Sub-Saharan Africa. And a totally different aspect is then something we've recently tested to offload fund investments to a private institutional investor who, having experience with the quality of the fund and the investments we originated, now feels comfortable to invest alongside the fund, basically. So part of the portfolio was offloaded directly to Calvert Impact Capital, a US-based impact investor. And that freed up the limited capacity of the fund to originate new loans to investees. And this offloaded portfolio continues to be monitored and by us, and thereby continues to generate positive environmental impacts. There are numerous other examples, I think, on how the concept of structured fund is continuously refined and reshaped And with the growing interest of the private sector, the cooperation of different investor worlds will increasingly be strengthened. So the public and the private sector will work more closely together than ever before. And with that, maybe I rest and happy to respond to questions later.
Thank you so much, Milena, for this great presentation. I think it was very insightful, even for people who may not be so familiar with structured funds, and also explained well the use cases and the variation and new latest development. Thank you very much for that. I'd like to ask Paulo now to tell us a little bit more about outcome-based finance and how this plays out at EBRD. So EBRD is obviously a development financing institution investing in Central and Eastern Europe and various countries there. Also has a lot of experience with innovative finance, really also at the forefront of local currency finance. But for this specific session, I'd just like to focus on outcome-based finance. Over to you, Paulo. And I think you are not sharing any slides, so yeah, exactly, we can do without. Welcome.
Thank you very much, Anya, for the introduction. Thank you for inviting me. Correct, I don't have a presentation to share, which means that you'll have to do with my face and my beautiful bookshelf behind. Just been told that the largest book is one about beer, so perhaps not the most topical book to have. In any case, my job here in this small intervention is to make things simple. I think innovative financing is a growing sector. Impact investing is a growing sector. There are many different terminologies. There are lots of different products and lots of different things. I actually believe that things are described in a manner that is more complicated than they actually are. So I'm here to bring sort of some clarity. And when I was initially asked to speak here, I immediately thought of focusing the little speech on EBRD's experience in impact bonds, and specifically our investment in the West Bank and Gaza employment impact bond. And while I obviously could do that, it's development impact bonds is a sexy topic. You know, given even the names of it, a bond, you assume something that is financially well structured and development and impactful, and so it grabs a lot of attention. But there is no need to just focus on developing impact bonds. And what I want to chat about is the bigger brother and sort of the family within which impact bonds sit, and that family is outcome-based financing. Now, outcome-based financing, what is it? It's an extremely simple concept. It just means that when investors make their investments, instead of having, like in most debt transaction, structured finance transaction, is certainty about the income, namely the interest rate that they will receive. There is a fixed amount in there that can vary, but there is also a conditional amount. A conditional amount can be as small as 5%, up to 100%, that is dependent on the achievement of certain pre-agreed goals. And like I said, it's a very simple mechanism and a very old one, but is extremely powerful. Now, why do I think that it's so important? Well, there are three different reasons. Number one, if you structure your outcome-based financing properly, you're giving the right incentive for parties to achieve what you want them to achieve, whatever that may be. It could be an increase of women in the labor force. It could be better environmental disclosure. It could be less emissions, whatever it may be. The second related topic is that you allow to price that component. Some people call it an externalities. Some people call it a main part, but you give it a price. And at the moment, it's very murky, and people don't know what is it that you should pay for that outcome. And if everything will get done properly, this instrument also allows for transparency, and therefore reiterating the point of pricing and sort of creating a market for it. Now, when it comes to EBRD, We are working in outcome-based financing with mainly 3 different products, mainly 3 different ideas at different stages of development. It's work in progress. We are beginning. I hope that we will continue to do more, and we will do more. But the 3 components are, like I mentioned at the very beginning, impact bonds, and in particular, we made 1 investment in West Bank and Gaza. I'll explain it a little in a little more detail. And we're currently looking at sort of other opportunities in the sector. Before we can do anything, we will need to convince our institution that we achieve good results in Palestine, that things are going well, and more importantly, that we learned how to do things better. And essentially, the investment in West Bank and Gaza is a program to try and give employment to up to 1,500 unemployed young Palestinians through the provision of very tailored trainings. Now, the whole idea of an impact bond is the following. In traditional programs, whether they're sponsored by governments or whether they're sponsored by donors, and here I'm speaking about employment, but could be any other social challenges, generally the government and the donor spends the money, the training is then dispensed, so to say, and then what happens after is a little bit less visible. It's a little murky. And it's not really clear whether the people that receive those trainings get onto an internship, are able to get a job, and eventually retain that job. In the impact bond model, what happens is the investors, in this case us, together with other very good local and international co-investors, will receive our money only on the achievement of certain pre-agreed outcomes that are related to young Palestinians actually having a job. And so, in other words, is a better value for money for governments and for donors. So that's impact bond. That's one. We'll leave that aside. The other big component is outcome-based loans or sustainable loans or ESG-linked loans. By the way, the fact that we have all these terms to define the same thing is really no good. It confuses people. It makes it, back to my point, makes things sound much more complicated than they are. Simple concept, outcome-based loans. You give a loan to a corporation, there is an element of pricing that is fixed in there, is what I said before, and then you tailor whatever you want the corporation to achieve, and if they achieve it, their interest rate is lower. As EBRD, we structured a couple of ESG-linked loans, and we currently started a program. We were awarded some money under the WIFI World Bank program, Women in Supply Chains, whereby we would give loans to various corporations, and the ultimate aim, and therefore the interest rate reduction, would be linked to the increase in the amount or in the number or in the quantity or volume of business that those aggregators or large corporates have with women-led or women-owned enterprises. And the third component, and I'm just the 30 more seconds, is sustainable supply chain financing. And it's really a mixture of 2 concepts here. So it's the concept of outcome-based loans that I just described, and the concept of supply chain financing, which is basically leveraging the strength of a large corporation to finance all their smaller suppliers. In this case, the only difference from what I previously mentioned is that the contingent element is not at the borrower level, but it's at the supplier level. And so, if the supplier, by way of example, achieves better ESG ratings, the suppliers will have access to financing at lower rate. And we like this because it's obviously more systemic in nature. It covers many different companies in the supply chain of large corporations. So I stop here, and maybe I address in questions what we will need in order to do more in this sector of outcome-based finance. Thank you for listening.
Thank you so much, Paolo. One could really feel also your passion that you have for the topic, and I think it's great that EBRD is really taking on the topic of outcome-based finance beyond the the development impact bonds, that where you already were pioneering a wonderful project in West Bank and Gaza. So I'd like to come back to a question that our colleague Frank Aswani asked of the African Venture Philanthropy Association. And his concern, it was actually a question he asked to Jan, responding to Jan's call for mobilizing more private social investors, philanthropic sector investors to really collaborate with KfW. But he's saying that they find that there is actually a lack of competence also and understanding about what innovative finance is and how foundations and investors for impact can actually engage with development financing institutions and other actors who are already working in this space. So we prepared a short poll for you to really understand what has kept you away from engaging in innovative finance in the past. Okay, we can see lack of awareness, knowledge, and internal capacity really seems to be a big issue, as Frank mentioned. So we will try and do our best as EVPA also to address that. Also interesting to see that for some the financial returns seem to be insufficient. There's a perception of a high risk. Yes, very interesting. Thank you very much. So we are about to close this session. But before we do this, the first part of the session, I would say, but before we do that, I'd just like to ask our panelists to really make a suggestion, maybe, about the way you hope to engage the European or African or global investing for impact community. In which way do you hope that they would engage differently or more in innovative financing mechanism? And you may also, of course, close with a call for action or a pitch for whatever you feel is relevant and of interest to the community that is here. So I'd like to ask you, unfortunately, to be very short. We only have a few minutes remaining. So if each of you could limit your statement to maybe 2 minutes maximum. Thank you. Paulo, do you want to start?
Yes, thank you. I had 4 points, but I cut down to 1 or 2. And I think the most important one is the pooling of resources. And I think what is one big detractor in the sector of at least the one that I spoke about, outcome-based financing, is the fact that institutions often see this as a very complicated instrument for relatively small transactions, and that's obviously a no-go, and it really hinders its development. And in a lot of these transactions, the element of conditionality, we do need to have donor support. And it would be great to have bigger pots of money with sort of donors working together in order to put them in one pool, maybe addressing the subject of employment, maybe addressing the subject of environment, but that we then as investor can sort of take from that pool in a very easy way. And related to that point is standardization of documentations. I think at the moment, every institution is trying to do their first capital transaction, and obviously they go about their own way. They have their own committees, they have their own differences, but having all these products that are also similar but with slight different tweaks, it serves the industry no good. It's normal because it's the beginning, but we definitely need to standardize all the documentations and to make it more scalable.
Thank you so much. Milena.
I'll stick to the topic of structured funds, of course, and my statement is both a hope and a plea. We've launched these funds and started talking about public-private partnership only, and and called it PPP. And I would hope that we can really use these PPP as public-private philanthropy cooperation, because what we still see a lot is that it's basically either philanthropy and private or public and private, but all three together is rather rare. So to both see maybe philanthropy playing a stronger role in also providing first loss or pitching money for a technical assistance facility but also, and that to me is almost more important, to use their endowment funding to do true mission-based investing. We don't have to use philanthropic funding only as grant funding, but that is something that we still don't see enough, that endowments are used to invest in the topic that the foundation is interested in any case. And I think there are, with these structured funds, very good opportunities out there that provide a fairly safe space also for the endowments to test and try these investments. So whoever is out there listening to this and would like to learn more about opportunities for investing.
Yes, I can see some great opportunities happening there at Finance in Motion. Also, there was a question on local currency, L-share mechanism. I'm sure you would be happy to respond to that as well after this session. Jan, Martin, what are your requests? What are your suggestions how the Investing for Impact community could get involved in your project?
Yeah, just two quick points going back to what Paolo said. You know, the products that we've created and the concepts that are being bandied about are unnecessarily complicated. And why is that so? Because we are complicated. And I think the DFI community and development partners generally have a big job to do in order to declutter not just their language, but also to make them capable of being partners. You know, that's really a challenge where we have to come together. So that's homework for us. And that's, by the way, not just something that's relevant for innovative financing, that's something of general relevance, if I may add that. And then secondly, I think Milena put it quite well. I think what we're hoping for foundations, but also commercial investors, is that they are willing to step out of their comfort zone and to look outside of their general way of doing business. I think we ourselves coming out of a long history of, you know, mostly providing grant funding on behalf of the German government, which is sometimes very important. But there are also opportunities in where you can, you know, make commercial investments and commercially driven decisions. And I think for a foundation, not just to look at their annual spend, but also their endowment and in which they can be relevant in investing into that space, is something that's very much overdue. And by the same token, I think we would also expect that, you know, people are open-minded to talk about the actual risk profile of some of these investments that we're looking at. I think we're seeing, to a certain extent, understandable reluctance to engage in certain countries and sectors that we know well because we have invested there for 20, 30 years. And I would sometimes hope that there's a bit more open-mindedness to look at the actual track record of various countries and sectors that we have invested in, and where perhaps you don't need, you know, 100% first loss cushion to put some money on the table.
Thank you so much. So now we have a couple of really interesting suggestions on the table, starting from a thematic outcome fund, pooled funding by outcome payers, a standardization of terminology that was also echoed by Jan earlier on. Milena suggesting to really turn the PPP into a PPPP. Or even social sector, and to play for philanthropy, to play a stronger role in first loss and technical assistance, but also use the endowment for philanthropy, to use the endowment as an investment opportunity into these innovative financing vehicles. And then for Jan, who made a pitch for the development agencies to do their own homework and get out of the comfort zone, but the same to apply for all the other actors where we need to collaborate together, and also really look at commercial opportunities for impact and make use of market mechanism to generate impact. With these few remarks, I'd like to hand over to Peter for the closing of the first part of the session. Thank you very much.
Excellent, thank you, Anya. And yeah, so the first thing I'd say is to 100% make clear we're not finishing. We have 15-20 minutes of interesting discussion to challenge everything you've heard or learn more coming up, but we are aware that some people may have to drop off. So we just wanted to take this chance to thank you for coming along. I hope you found it useful content, and we'd love you to join us in the journey as we build this community and address some of these issues. We will be getting a survey at the end of this webinar. We can't escape from them, but please do fill it in. It does help us to understand how useful this is. And also, if this has really whet your appetite and you want to learn more, and an hour is not long enough, although my computer seems to think otherwise, there is an opportunity to join us on the 3rd of June for a deep dive session where we're being joined by not just a number of the people here today, but also being led by real experts in the field on outcome-based financing, led by Social Finance UK, Roots of Impact, the Swiss Development Corporation, and also Lombard ODA. That would be a really interesting panel. It's also a new format for us. And so we're really looking forward to really diving into some of these issues that often a quick webinar can't quite get you to the bottom of. So please do feel free to get involved with that. That is a EVPA member and sister organisation exclusive event, but we're very happy to see you come and join us. We're very happy to see you join EVPA. Obviously, let's be cynical, but also we really want you in the room, because this won't work if it's just the three of us who all agree with each other. So please do look for the registration and or get in touch with us if you want any more details. And we will be following up with some details from the chat. But now, no doubt having missed one or two things I meant to have mentioned in closing, I will just hand back to Anya to continue the discussion for the next 15-20 minutes. Thank you.
Thank you so much. You will have the opportunity for a second closing in 15 minutes. But before we move on to the closing, I'd like to invite those of you who had not a chance to speak yet to really share your experience with innovative finance activities. What have been the difficulties, the success factors? Please join us here on the panel. You can just raise your hand. I'd love to hear also from those who were not represented here in terms of working for and DFI specifically, the foundations maybe, or any other organizations that are involved or would like to get involved to share their experience. So just raise your hand and we'll just unmute you. Otherwise, we'll just mention a name here. I'll just go through the list and ask someone to share their experience. While we're waiting, maybe I can ask our panelists, what has been your experience when you approached foundations, for example, or private investors? What were you told by them? What were the main comments they made? Anybody?
I think with foundations in particular, we still see a huge divide within foundations of those that are managing the endowments and those that are responsible for the grant programs. So a stronger collaboration in the background could maybe be useful. Generally, I think private institutional investors are catching up with the experience that they have. Now you approach them and at least they know what impact investing is. They have heard about these concepts. So there's a better intro already, but yet it's the first time. And there's still a lot of convincing probably to do within the organizations to move into that direction. So the experience is still far behind what the DFIs bring to the table, and some catching up will still have to take place.
And what would be required so that this catching up can happen? What would you like to see in place? Is there some more active role that you could play, or do you expect other actors to do more? Maybe EVPA could also play a role in that.
Yeah, I was thinking about that, because also organizations like the Global Impact Investing Network, the GIN, play an important role, because they bring these parties together, and also private institutional investors that also already have a great deal of experience in impact investing, because it's not like they wouldn't be doing anything. That's not what I wanted to get across, but that they can also learn from each other. Yeah, sometimes it's also easier probably to learn from like-minded or the same type of investors than this peer learning could something that organizations like the GIN, EVPA, AVPA can all facilitate.
Yes, and definitely there's a need for that. And what you're saying also suggests that a lot also relies on personal connections that people make, isn't it? It's very much about meeting someone who is already doing something like that, or even meeting your peer. If you as a pension fund meet someone else who's a pension fund and invested in the Danish climate whatever fund, then that will maybe help to convince this person that something similar is also possible for them. So there is really this peer-to-peer, but also talking to other people outside of the comfort zone. Is there anybody here in the of the participants who'd like to join the conversation and has some thoughts to share? There's some comments here I can see from my colleague Sophie. Do you want to come here and share these comments with us? I think, Peter, you have to unmute her. Or did she leave now? She left her comments. Oh, Giovanni, yes, why don't you come here? You made a comment earlier about local currency. Maybe you share a little bit with us why you're interested in the local currency aspect. And of course, we'll get the context also to you with and share the context of the panelists. I think this was your question.
Sure. Mainly interested because we are invested in a number of high-risk countries where sometimes local currency fluctuations impact heavily either the fund manager or the organizations. And there has been typically no way for us to mitigate on this front. So yeah, but, I mean, just very generally interested in how these L shares work and how funders are willing to either let go of their investments, or if they're okay with a first loss being an intrinsic part of funding, and whether or not it's something that it stays on forever, just because currency fluctuations are not something that will be predictable, and yeah, just generally curious on how public-private philanthropic partnerships could work to mitigate all of these things.
Yeah, interesting. Giovanni, could you just repeat again? Who are you working for? What organization do you represent?
Policy. Yeah, Triple Jump.
A Triple Jump. Okay. Yep. Yes. So this is obviously the local currency aspect is obviously something that you are very much familiar with.
Right, exactly. And I mean, for us, it's we invest in hard currency, we invest in local currency, but it's just for us, it's always fairly risky to go in local currency where there are heavy forex fluctuations. So for us, we're either having to price up in order to consider investing into high-risk countries, or having to find some sort of innovative hybrid methodology in order to mitigate. And this is sort of where
which are certainly very costly. I mean, they do exist thanks also, I think, partly to KfW engagement with the TCX. Jan, do you want to?
I can just add. I mean, as you will know, the whole subject of local currency is a systemic structural issue, right? Whatever we do, either by providing L shares directly into structured funds to mitigate some of the local currency risk, or by supporting institutions such as TCX that can provide hedging and swaps in the market, it's like putting a plaster on an open wound, because for as long as you don't have deep capital markets, well-regulated capital markets, a stable currency in the target countries whose currency you want to finance, you know, it's something that will always remain challenging. So long-term for us, and that's why we are also supporting initiatives such as the Africa Local Currency Bond Fund and others. Long-term, the end game needs to be to support capital market development in these countries in order to, you know, have decent local currency offerings on the table that don't provide some level of concessional support. And I think the L shares, Milena can speak about this more intelligently than I can. You know, they're obviously integrated into the capital structure of individual funds to provide some level of currency hedging against you know, fluctuations across a range of currencies that the fund invests in. But, you know, obviously it's a very inefficient mechanism, as you can imagine, right? Because you only have a small basket of currencies. And so just from a mathematics standpoint, you know, over time, these L shares will have to melt down. There's no other way, because emerging developing country market currencies will or tend to depreciate against the euro or the dollar. And so you have a very one-sided risk equation at some level. We do believe it's still necessary, especially in real frontier markets where we don't want to burden borrowers with hard currency risk. But it's long-term really something that is a structural problem, where L shares or TCX and so forth is really just a, you know, a small plaster on an open wound.
Okay, yeah, thank you very much. I like the way you highlight really the strengthening or the need to strengthen local capital markets. I think this is one of the indirect impacts that, in my view, is not sufficiently valued also, because we are all obviously looking for the direct impact on the SDGs, the number of beneficiaries that we reach, and this is very important. But in order really to achieve scale in the long term and to really set up something that works beyond our own transaction, and I think we really need to invest in systems in those countries. I have a question here from Frank, and I wonder, Frank, would you like to ask the question yourself, or would you like me to ask the question? It is about, you know, about the size of innovative finance or blended finance transactions, which are very, very big, and the question is really, are there also opportunities for smaller tickets investors deploying grants, debt, and equity, or do we always talk about these large transaction and structured funds?
Thanks. Yeah, that's the if we look at what we're seeing on the African continent, where we're also trying to build an ecosystem of social investors who we hopefully will be playing a significant role in deploying capital. Majority of them are still very much in the nascent stage, and it's part of the capital markets building plan. But the models that we've seen being deployed in innovative finance in Africa are really in big projects. We don't see a lot of involvement of smaller ticket players where majority of our social investors sit. I mean, relatively, even a corporate foundation in Africa is probably the size of a family office in Europe. But so how do we, is there space for this kind of players in innovative finance, or are they locked out by the very nature of the mechanisms available? So that's a question I'd like to ask. And if so, maybe it's part of the innovative finance education that we need to do to them to bring them up to speed.
Who would like to take on the question, Paulo?
Yeah, maybe I can take that. I think because also I made the point before about needing to have even bigger size. So this is a good question to answer. And two things on that. I think obviously the size of the transaction needs to be adjusted for the opportunities that can be investable in a particular market. And I think whoever is active in multiple markets absolutely needs to make that distinction. And so big is on a relative scale. And the second thing, and the reason why, Frank, I guess you find innovative financing more in larger transactions, simply because, like I said before, there is no standardization, and it takes a lot of time for institutions such as well, I can speak for my own example for EBRD to sort of do something that is slightly different from the norm. And if you're spending all that time and all that energy to do that, then people will only want to do it in general terms. Obviously not me, but if the transaction is larger rather than smaller. In time, with standardization, I think this issue will be progressively resolved, or at least that's my hope for it.
Thank you so much. Thank you so much. Yes, Milena, you want to add on that?
Just to add to that, because I think that it's also important to differentiate between pooling funding or being innovative on a deal-by-deal basis, or why we believe it's also so important to have blending at a fund level. Because then what Paolo mentioned, the complications of bringing so many players together and structuring a more complicated deal happens at the fund level. And the fund investing or providing smaller tickets to one investee, that investee will not even realize necessarily anymore that it is a blended finance structure in the background. And it's then simpler at the level of the individual deal. So some of it can potentially be, outsourced to that level of fund.
Thank you, Milena, for that contribution. I'd like to come back to the question of local currency. Obviously, there's quite some interest here, and I'd like to ask first Nadia to share some of the insights from EBRD on local currency finance. I know that you are very strong in this field, and then I'd like to ask Roberta. Maybe she also has some remarks on that, and just to close this session with some final remarks. Thank you.
Thank you very much. I'll be super brief, because I think as we move to smaller ticket size and working with smaller companies, local currency becomes paramount, because for smaller guys, local currency is the source of funding they need, not FX. So at EBRD, what we do, and Ian mentioned it very well, is that very important is what we do at the level of local capital markets. And at EBRD, we run a very successful local currency program where we provide local currencies to SMEs, either through banks or directly, because we do a lot of also direct investing to SMEs, whereby we, as a basis for our engagement and the ability to provide local currency, is to sign a memorandum of understanding with the relevant countries and work towards improvement in the local capital market. So that's very important. And the other thing which enables us to do that is the first loss. So blending there is very important, because the cost of funding, whether it's TCX or whether it's the bonds which we could raise as well in the market, still the cost of funding is very high. But it's very, very important as we move to smaller guys and smaller ticket size for smaller companies.
Thank you very much. Thank you, Nadia. And I know EBRD has really done wonderful work. I just copied the link to your local capital markets initiative here in the chat. Roberta, what are your thoughts when you listen to our panelists, our participants? What do you make of all this discussion?
No, that's been a very interesting hour that we spent, and it's great to hear this call for action and appeal to get more involvement from the philanthropic side, from the foundation side. I just want to voice one element, and I think it was also what Sophie, our colleague, was trying to say, coming also from the foundation, corporate foundation. I think the philanthropy side comes in many extent from a perspective of a lot of non-financial support, hands-on engagement, direct control over the impact at beneficiary level that they can create. And this can be really a hurdle and a barrier to the concept of just contributing financial resources into an impact fund for development and blended finance. So I think in trying to build bridges and simplification and standardization, so I hear what both Ian and Paolo and Milena are saying. I mean, I think there is some work to be done on both sides on how do we bridge those two sides. I mean, obviously the need for resources is there. I would really encourage to move the debate beyond the financial resources, because I think what the philanthropy sector, the engaged grant making philanthropies and investing for impact community can provide is a lot of non-financial support and the capacity building and the impact measurement expertise. So if we could find a way to develop mechanism to bring that expertise to the table as well, I think that would make the collaboration, would facilitate the collaboration. I'm not saying it's going to become easy, but I think it would facilitate it, because at conceptual level, I think everybody's moving in the same direction, and there is openness. Is more the barriers on the level of expertise, and how do we make the most of all the stakeholders that we can bring together. But that's a little bit, I think, there is some work to do, but I think is a great first start. There is a lot of interest and appetite. We just need to be the translator. And I think that's a role where probably EVPA can play a good role in being the translator across the two community and trying to facilitate this collaborative dialogue to say, okay, how could this work? Right, beyond the endowment investment strategy, beyond the fundraising for funds. I think there is more than the investing for impact can contribute in terms of expertise. How do we leverage that?
Wonderful, Roberta. I think these were great works to see us off and give us also some homework to do. And I hope that many of you will see you again at our deep dive on the 3rd of June, where we're really going to look at some detailed financial structure to really understand also what are the opportunities across different spectrums of engagement of grant makers, that equity in engagement in these innovative financing structures. So thank you very much for being with us for such a long time. I know for some it is the lunch break already, or it has been the lunch break. So we very much appreciate your attention and looking forward to seeing you again soon.
Thank you. Thanks, Anya. Thanks, the panelists. Thanks, Peter. And we'll see you soon. Bye. Bye-bye.
Bye.
Thank you.
Thank you. Bye-bye.